Hi, we would like to welcome you to the Tulane University Berkman Report's 2016 video presentation of the continuing coverage of Denbury Resources Incorporated. My name is Kelly Polander and I'm speaking on behalf of my fellow analysts Andrew Kleiza, Emily Lambert, Walker Netherton, and Alex Starlight. We would like to thank our investment research manager Grace Kamick for her continued guidance throughout the research process. Our team of analysts gives Denbury a market rating of market perform and a 12-month target price of $3.60. Below is a graph depicting the 3-year historical performance of Denbury stock. The company's stock price on the date of the report, March 17th of 2016, was $2.61. This presentation will first provide a brief overview of the company, including its operations and corporate strategy. We will then discuss the oil and gas industry, outlining the major drivers and current trends. Next, we will review the valuation method that was employed to reach our 12-month target price. Then we will discuss the company's plan going forward to maintain liquidity in the current oil and gas environment. And finally, we will summarize the presentation. Denbury is a unique energy company that focuses on the use of carbon dioxide enhanced oil recovery to revitalize conventional wells that were previously uneconomic to produce under natural reservoir conditions. The company's total production consists of 95% oil production. Of this production, 57% is recovered using CO2 enhanced oil recovery techniques. We will explain this technique in the coming slides. This table is a snapshot of the company's stock performance on March 17th of 2016. Some key figures include a market capitalization of $915 million, total shares outstanding of 350 million, and a 52-week trading range between 95 cents and $9.44. Denbury's operations include the Gulf Coast and Rocky Mountain regions. The company's major fields of operations include Delhi and Tinsley fields in the Gulf Coast region and Cedar Creek Anticline in the Rocky Mountain region. The company also has access to major sources of CO2 that are used for tertiary recovery in Jackson Dome, Mississippi, and the LaBarge Field in Colorado. The company is also able to recover CO2 from industrial sources in these areas. There is existing infrastructure in place to efficiently move the CO2 from these sites to the fields of operations. In order to enhance oil recovery from wells unable to produce under reservoir conditions, Denbury injects carbon dioxide from an injection well. The CO2 frees the oil from the formation and allows it to easily flow to the surface through the production well. Some of the CO2 can be recycled and reused. Denbury's total production currently averages 72,000 barrels of oil equivalent per day. Management suggests that there will be a 12% decrease from the fourth quarter 2015 to the fourth quarter 2016 due to shutting in uneconomic wells or fields and a reduction of CapEx to bring new wells online. However, the company will be able to hold production steadier than most because of low decline rates of their wells due to their tertiary recovery. This graph displays actual 2015 production and projected 2016 production. Currently, many oil and gas companies are in survival mode. Many are struggling to maintain liquidity and keep up with their debt covenants. The majority of companies are seeking and implementing ways to reduce capital expenditures and maintain their cash flow in this low price environment. In most cases, break-even costs for oil and natural gas exploration and production companies are above current prices. The most significant market driver in the oil and gas industry is commodity prices. For Denbury, who predominantly sells oil, the WTI crude oil price is the most significant factor for generating revenue. As you can see on this graph, crude oil prices have dropped by more than half over the past 2.5 years. The lower for longer mentality has gripped the industry as demand has struggled to catch up with excess supply. Companies are struggling to lower production costs and increase efficiencies in order to keep economic and current price levels. To obtain our company valuation, we constructed a PV10 model. The PV10 method is a common valuation used for exploration and production companies. It values companies based on projected future production from their current reserves and then discounts the projected revenue by the industry standard 10%. The two main drivers in the PV10 are the production projections and price projections. While production projections are fairly similar among analysts, price projections can vary vastly. We use the Birkenroad WTI forecast for our price projection. In this section, we will detail the plan for Denbury going forward in order to maintain liquidity in the low price environment. The company is currently in the process of reducing capital expenditures, restructuring its debt covenants, implementing hedges to reduce price risk, and finding ways to increase operating efficiencies and reducing production costs. We will discuss each of these strategies to maintain cash flow and shareholder value. One way to help sustain cash flow is to cut expenses. Denbury has plans to reduce 2016 by 50% relative to its 2015 CapEx. This budget is broken down into two main areas: capitalized items and developmental capital. Capitalized items include internal acquisitions, exploration and development costs, and startup costs to conduct tertiary floods. The development cost plan sets aside $100 million for the tertiary recovery activity and $35 million for non-tertiary production activity and $10 million for CO2 activity and other expenses. Another means of cutting expenses is through cutting production costs. Denbury has been able to cut lease operating expenses for lease and well activity by 16% from the fourth quarter of 2014 to the fourth quarter of 2015. General and administrative costs have also been lowered in order to help maintain a healthy balance sheet. Denbury has been able to restructure its long-term debt to push it back until oil prices have time to recover, as you can see from this graph. The company has implemented a hedging strategy that will allow them to mitigate the financial risk of oil price volatility. The company is approximately 50% of their total production hedged going into 2016. This graph illustrates the prices that oil must reach in order to be profitable in each quarter. To reiterate, our team of analysts projects a 12-month target price of $3.60 for Denbury Resources. As noted, we believe that cash is king. Denbury's ability to maintain liquidity throughout the downturn commodity prices is the key to the continued success of the company. Our team would like to thank you for listening to our presentation of the continuing coverage of Denbury Resources Incorporated. Disclaimer: the Breckenridge reports are produced solely as a part of an educational program at Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decisions. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.